Most business owners think that taxes happen in April with the filing of your return, but they don't. When you complete your work, you know you're going to get paid because you have earned that money. You're just getting paid soon after the fact. Conversely, if you outsource designer or developer work, for example, you know you're bound to pay your people afterwards because they have earned that money from you and you incurred it. Keyword there, by the way, incur. Because that's exactly what happens with taxes. You incur tax expenses with every dollar that you earn, with every dollar that you make, and you get to pay it later. So in this video, I'm going to show you how you can calculate how much taxes you are incurring without having to wait for your CPA to prepare your tax return after year end. I'm Jose Cardenas, CPA and enrolled agent at Westfront Tax and Accounting. We provide bookkeeping, business accounting, and tax services to service businesses with a specialization in creative and marketing agencies. The good news is that knowing how much tax you have incurred so far for the year or for a given month could be fairly easy, okay? You simply multiply your effective tax rate from your most recent tax filing by how much profit you have made so far in the year, not revenue, profit. The effective tax rate is essentially the percentage of your total income from all sources that ends up getting paid in tax. It's a simplified method for you to take into consideration your tax adjustments, your standard deduction, your QBI deduction, and any other credits that you may have that you may not know about or understand without having to understand. So if you look at your 2025 personal tax return, for example, you can get your total tax on line 24 of your Form 1040 and your income from line number 9. You divide the total tax by your total income, and that is your effective tax rate so that you can use that percentage to estimate how much tax you have incurred for the year or for a given month on your business profits. Now let's talk about the bad news and why I said getting your effective tax rate could be fairly easy. First, logically, if your prior year tax return is wrong, the effective tax rate that you're calculating will also be wrong. Second, if your total income this year, not just from your business, but also income from other ventures, investments, or from your spouse, maybe she has a W-2. If the total of all these sources is going to be materially different from last year, say by 50 or over $100,000, then the effective tax rate that you're calculating from last year may not apply this year. Because think about it, you are leaning on prior year thresholds and prior year circumstances to project this year. And well, unfortunately, the only constant thing in business is change. But even with those limitations, I think that if your business and your other sources of income are fairly stable year over year, you can most certainly get visibility into your taxes that you have incurred so far in real time on your business profits. With this in mind, then the question is, okay, how does this fit into the famous quarterly estimated tax payments and the filing of your return? And I'll start with explaining what estimated quarterly tax payments are. Basically, the IRS wants you to pay taxes that you have incurred during the year and during the quarter you made the money in. Part of the reason why the deadlines are April 15th, June 15th, September 15th, and January 15th, but they decided not to burden you with getting precise about how much taxes you have incurred to pay. Hence, they came up with, call it a safe harbor threshold, how I like to call it, which basically says, hey, look, you're not required to come up with a precise number on how much tax you have incurred. Instead, just make sure you pay the lesser of what you paid last year or 90% of what you think you're going to owe for this year, for the year in question, to avoid penalties. Any differences, if you make more, just cover it by April 15th of the following year. And if you made less and you ended up overpaying, you can either get a refund for that amount of money or choose for the excess to be carried forward for the next year. Small difference for those making over $150,000 a year, you would have to increase your prior year tax number by 10% when comparing which of the two is the lesser one. So it would be the lesser of 110% of prior year tax or 90% of what you think you'll owe for this year. So you grab the lesser of the two numbers and you make sure you pay a quarter of that, 25% of that number by the quarterly tax payment deadline. Or if you want, you can make multiple payments every month as long as the total for the given quarter equals what you would have paid in one payment. If you completely miss making any payment at all during the year, then you're basically back to square one of finding out how much money you need to pay out of pocket to cover the taxes with the prep of your return with penalties that you could have avoided, to be honest with you. This is why we help business owners not only track how much taxes they have incurred every month or so far for the year, but also how much is still pending to be paid, because we consider all of the constantly moving levers, because most business owners, they also pay themselves through payroll, and they may choose to max out their withholdings on those paychecks that they give themselves as employees so that they don't have to worry about making any quarterly payments at all throughout the year. Or sometimes the opposite happens. They have payroll with a withholding amount, default amount, and then they just come and compensate with actually making the quarterly tax payment timely. So sometimes they pay the minimum to avoid penalties. Sometimes they choose to pay enough so that come tax time, we come around, we prep the tax return. They know that they don't have to come about more out of their pocket to cover taxes, because if there's any excess, they just choose to carry it over to the following year. So we consider all of these different moving parts to help you manage the cash. This is how you strategize. This is how you manage cash flow to cover taxes while maybe investing back into your business, or maybe for you to go ahead and buy a new home or buy a new car, up to you at that point. So if this is the kind of support that you're looking to get, you can book a free discovery call with me. The link is in the description below. For you watching this video, I'm going to give you some inside baseball that almost every year our wealthiest clients do. They basically completely miss making any of the quarterly tax payments, and instead they use their tax money to make more money. Why? Because they see the penalty as a low interest loan. For the case, the penalty is lower than what the interest expense would be if they were to take out a loan with the bank for the same amount of what their total quarterly tax payments should aggregate to. This way, they know that with the prep of the return, they just need to remember to make sure to cover the total outstanding balance, and they are okay with the penalty at that point in time. And just remember by April 15th of the following year in question, because remember, you can extend the filing requirement, but not the payment deadline requirement, which is again, April 15th of the following year. Lastly, if you haven't already, make sure you create your online IRS portal by going to the IRS website at irs.gov. You can completely get rid of having to check the mail for any notices, and it is hands down the best way not only to stay up to date with the IRS in real time, but also to remit your tax payments. And with that said, that is all I have for you today. Hopefully you liked the video. Hopefully you found the video insightful. If you did, make sure you smash the like button for me, follow the channel, subscribe. And with that said, I'll see you on the next one.